So, pivoting back to more the macroeconomic discussion, I mentioned in my opening remarks the bank failures that we saw in the first half of 2023. And of course, we want to think of those in the rear view mirror as something in the past, but was notable. And we're coming up on earnings season here, and we'll be hearing from JP Morgan soon, a bank that Albion owns. And I'm wondering, Jason, can you talk to us just a bit about what we're seeing in the banking sector now, and any potential sort of discussion about regulatory changes in light of what we saw earlier this year?
Sure. So the way that we view it is the acute part of the banking crisis, for lack of a better phrase, has passed. Um, Policymakers stepped in, whether it's the FDIC, Treasury, et cetera. They stepped in and did the right thing in rebuilding confidence around deposits because that was really central to the panic that we saw in the spring. Um, and by doing so, that prevented a more widespread banking crisis. It wasn't just the federal government that stepped in, but it was also large banks like J.P. Morgan that came together and tried to really make sure that this didn't spiral out of control and go sideways like we saw in 2008. Obviously, very different. The essence of what we saw with the regional banks this spring was very different than what we saw 13, 14 years ago, I guess 15 years ago now, time flies. But the acute phase is past. So where we think we are now is in the more chronic phase, meaning that there are likely real economic implications from the stresses that we've seen in the banking sector in the form of reduced lending, reduced investment, and even lower profitability for the banks, especially as regulations intensify, which we think they will. So on that topic, in the second part of the question about regulations, we do expect that in the probably years ahead that we will see new regulations addressing some of these gaps in the banking system. In particular, banks between the 100 billion and 700 billion mark in terms of assets are likely to face new capital requirements. Federal Reserve is talking about this. There are members of Congress that are talking about this. And there was a piece of legislation a few years ago that kind of softened and undid some of the more stringent regulations we saw post Great Financial Crisis with the Dodd-Frank bill. And unfortunately, that softening of capital requirements for that slice of the U.S. banking community ended up contributing to some of the failures that we saw this last spring. So I think we're going to likely see a retightening of regulations for that specific slice of U.S. banking, which is important. I mean, we think that's smart. We celebrate that. We saw the U.S. banking system put under much more enjoy much more stability in the years after the 2008 crisis because of the Dodd-Frank laws, because of the regulations that were enacted to make banking more sound. So we think following a similar roadmap here on the other side of the three failures we saw this spring and closing some of those gaps in regulation for those large regional banks makes sense as well. And again, it appears at this point, and this is again going to take years to probably flesh out because not only is this stuff complicated, but there's a well-heeled lobbying effort by U.S. banks to kind of push back against new regulations. So it's going to take time to be put into place. But the bottom line is we do think new regulations are coming. In the shadow of what was a pretty scary few weeks there in the spring.
And I think it's important to note that this was a bank run unlike any we've ever experienced. The internet has enabled us to have a run overnight that removes tens of billions from a bank. That never happened. It took time for money to leave a bank. There was friction to moving your money away from your bank. Now it's virtually frictionless. So the technology is far ahead of the regulatory environment that needs to figure out the best way to allow capitalism to function, because that's a critical tool, and yet do it in such a way that we try to remove some of this now new systemic risk.
I think one other area within the regulatory framework that we're likely to see, or I would hope that we would see some changes, is in how the Fed conducts stress tests. I think what happened with Silicon Valley Bank and Signature Bank and the like, First Republic, opened up a kind of a glaring hole in how the Fed conducts their annual stress tests. So each year after the you know GFC, after the Great Financial Crisis in 2008, part of the Dodd-Frank law was that the Federal Reserve was going to put the largest banks in the U.S. under what they call stress tests, which basically stress tests the bank's balance sheet and financial position for what they call adverse scenarios. That is like a decline in GDP, decline in house prices, a decline in stock prices, et cetera, et cetera. They've been building in these disaster scenarios to see how well capitalized the banks are and whether they can get through those periods of stress without creating another systemic crisis like we saw 15 years ago. And it turns out that we're always kind of fighting the last war, and those stress tests were designed around the worst case downside scenarios, but they didn't take into account things like rising interest rates after 10 years of zero interest rate policy, the impact that has on bond portfolios at the banks, the impact that has on the ability to access capital when things tighten, et cetera, et cetera. So I think not only through the lens of higher capital requirements, higher reserve ratios, and just making the banks more sound within that 100 billion to, let's call it 500 or 700 billion dollar lane in banking, but in addition, changing how the Fed thinks about risk in US banking, both to the downside as well as things like when interest rates rise dramatically. Likely to see some changes there as well. But again, regulators and politicians drag their feet on these types of things, so it's probably going to take a few years to really see this come to fruition. But we do expect it.
Hey, Liz, I just want to build on one thing that Jason just said. That the Dodd-Frank regulations were designed for the challenge of the last crisis. What the regulations missed was just basic bonds 101. They were designed for what's called creditor risk, right? The creditor going out of business. But they weren't designed for the fact that bond prices go down as existing bond prices go down as interest rates go up. It's called duration risk. The longer the bond is out there, and that is just basic 101. So it's super frustrating for us, and it should be super frustrating for the country that our regulators did not catch that. That was a basic risk that should not have been overseen.
They missed the forest for the trees in a way.